Richard Murphy, and I want to talk about something that I've been working on, which is a submission to the International Financial Reporting Standards Foundation on whether or not they should become responsible for sustainability reporting standards. Now, a little word first of all about what the International Financial Reporting Standards Foundation is. This is the body that sets accounting standard rules for the UK, the European Union, and around 100 countries around the world. It doesn't cover the USA. They have their own rules, but they are fairly similar. It doesn't cover Japan. It does have an impact upon China. So it is very significant in terms of accounting. Why are they interested in sustainability? Because until very recently, they said they did not have the technical resources or the willing to engage with this issue. Well, everybody's now interested in sustainability, and it's becoming big business. There are a number of bodies, the Sustainable Accounting Standards Board, the GRI, Global Reporting Initiative, the EU, that are looking at setting standards for sustainability reporting. And perhaps in the lead, Mark Carney's task force on climate finance disclosures. Now, all of these are coming up with slightly different approaches, but there's one thing that they have in common, and that is that none of them require that the disclosures have any impact upon the financial reporting of the company who is making the sustainability report. And what is bizarre about the approach of the International Financial Reporting Standards Foundation is that they are proposing to become the standard setter for sustainability, but setting up a separate board to do this, quite distinct from their accounting standards board, as if accounting standards and sustainability standards issued by the same company are, well, virtually unrelated things. Now, my submission argues very simply and very straightforwardly that this is not true. The submission says that, in my opinion, accounting and sustainability are not only related, but that in fact accounting is now a subset of sustainability reporting. Because the most important thing that any form of financial reporting says is whether or not a company is what is called a going concern. Now, a going concern in financial reporting senses is a company that's going to last at least 12 months since the balance sheet date, or actually from the date when the auditors sign their report. But that obviously is an insufficient criteria for sustainability reporting. The critical point that I'm arguing is that if we look at the long term, and of course investment is a long-term activity, and how to allocate resources, the scarce resources, and they are scarce when it comes to financial investment of society, from pension funds, life insurance companies, everybody else who puts their money into the stock market, then what we're looking for now are companies who can adapt to the climate crisis, use resources effectively, and become net zero carbon sustainable businesses who can continue to make profits during the transition and into the long term because of their ability to embrace new methods of working which will reduce their carbon output to net zero and which might also reduce their impact upon biodiversity as well. Now, that, as far as I'm concerned, is a financial reporting issue because there's a cost involved. But if that cost isn't anticipated and reported as a necessary expense to be incurred, then the company is understating its liabilities and therefore potentially misrepresenting its true financial position. And if it doesn't actually declare whether it is even capable of finding the funds necessary to make that transition, then it may not be able to report itself as a going concern, in my opinion, creating the concept within sustainable cost accounting, which I have created, of carbon insolvency. Literally, a company that may look financially capable now, but which in the long term is not going to be durable because it can't raise the capital to make the transition to the point where its financing is sufficient to cover the cost of transition to being a carbon net zero company. So, what am I proposing to the IFRS? That they actually integrate the accounting costs of transition into the balance sheet of a company now. What then is required is that each year the company would report on how that provision for the total cost of transition has been spent. Has the company been successful in achieving its objectives? Has the spend been incurred? Are the company on track to achieve the goal in the time scale that they have set? Or have they discovered new costs and impediments to progress which requires a greater provision and therefore has an impact upon the overall profit and loss of the company? Now this, to me, is the future of financial reporting. A company that is not going to embrace sustainability to its very core is going to fail. But the IFRS Foundation, the International Financial Reporting Standards Foundation, is still working on the logic that somehow there is finance on one side of the page and sustainability on the other side of the page, and there the two shall meet. That's not true. That's not how the world now is. We're in one integrated, holistic whole, and anybody who's interested about long-term investing needs to know the impact of sustainability upon financial performance, and it's the job of this body above all else to integrate the two. That's the submission that's going to be made. I'll publish it soon, but I thought I'd give you a preview here.
Thanks for watching this video. If you've enjoyed it, I'm pleased. If you want to see other videos like this, there are links below this screen. If you want to subscribe, hit the subscribe button. Follow me on Twitter as well, @RichardJMurphy. Look at my blog, Tax Research UK. And if you'd like to donate, because this video series is being largely paid for by donations, there is a donations button on every single post on my blog. Thanks a lot.